The bullish breakaway pattern can indicate a potential reversal in a downtrend. It consists of 5 candles, a long black candle, followed by the next 3 candles, which are spinning tops with short real bodies. The second and fourth candles must be black to confirm the pattern. Additionally, the second candle must create a gap between the first and itself, and the fifth candle is a long white candle that closes within the body gap of the first 2 candles. This pattern suggests that the bears are losing momentum, and the bulls are starting to take control. The bearish breakaway pattern can indicate a potential reversal in an uptrend. It also has 5 candles, a long white candle, followed by 3 small spinning top candles with short real bodies. The second candle opens higher, creating a gap, and the third candle can be either black or white. Finally, the fifth candle is a long black candle. This pattern suggests that the bulls are losing momentum, and the bears are starting to take control. In a bullish closing Marubozu, the closing price is equal to the high of the period, and there is a small or no wick on the lower end, indicating that the buyers were in control throughout the session with no significant selling pressure. In contrast, a bearish closing Marubozu has the closing price equal to the low of the period, and there is a small or no wick on the upper end, indicating that the sellers were in control throughout the session with no significant buying pressure. Additionally, it's worth noting that bullish closing Marubozu typically have a small lower wick, while bearish closing Marubozu have a small upper wick. The closing Marubozu pattern is a strong indication of market sentiment, and it can signal a continuation of the current trend. The bearish counterattack candlestick pattern is a 2-bar pattern that can signal a potential reversal in a strong uptrend. The first candle is a long and green candlestick with a real body, indicating a strong bullish sentiment in the market. The second candle is a red candlestick, which opens higher than the previous day's close and rallies further before sellers take control and push the price lower. The red candlestick must be equal to or close in size to the previous day's green candlestick. In a bearish counterattack pattern, the red candlestick typically closes near the close of the previous day's green candlestick, indicating that the bearish sentiment is strong enough to counteract the previous day's bullish sentiment. This pattern suggests that the bears are gaining momentum and could push the price lower in the near future. Traders can use this pattern to identify potential short opportunities or to exit long positions. There must be a strong downtrend in the market for the formation of the bullish counterattack pattern. The first candle must be a long red candle with a real body. The second candle must also be a long, ideally equal in size to the first candle, but a green candle with a real body. The second candle must close near the close of the first candle. The bullish counterattack pattern is a sign of a potential trend reversal, indicating that the bulls may be gaining strength and could take control of the market. The Deliberation candlestick pattern, also known as a stalled candlestick pattern, is a 3-candlestick pattern that can occur after a strong uptrend. This pattern is often seen as a sign of indecision in the market. The first candlestick in this pattern will be a significant bullish candlestick. The second candlestick must open above the opening price of the previous candlestick, and it should close above the high of the last candlestick. The last candlestick should have a small body and the same opening price. It can close either above the high of a previous candlestick or below the high, but it should be a bullish candlestick. All 3 bullish candlesticks should form in a specific sequence and structure to confirm a deliberation pattern. The outside-up candlestick pattern is a bullish reversal pattern that indicates a potential trend reversal. This pattern consists of 3 candlesticks, with the first candlestick being a small bearish candlestick, the second candlestick being a larger bullish candlestick that completely engulfs the first candlestick, and the third candlestick being another bullish candlestick that ends higher than the second candlestick. This pattern suggests that the bulls have taken control of the market after a period of selling pressure, and it is a signal to enter a long position. The 3 outside down is a bearish candlestick pattern that appears at the end of an uptrend. It consists of 3 candlesticks, where the first candlestick is a bullish candlestick, followed by 2 bearish candlesticks. The second and third candlesticks are larger in size and completely engulf the first bullish candlestick. The pattern suggests a shift in the market sentiment from bullish to bearish as the bears take control of the market. Traders can use this pattern as a signal to enter short positions or to take profits on their long positions. To close is a bearish reversal candlestick pattern that consists of 3 candlesticks. The first candlestick in the pattern is a long bullish candlestick that indicates a strong uptrend. The second candlestick is a small bearish candlestick that gaps up and closes near the middle of the previous candlestick. The third candlestick is a bearish candlestick that closes well into the body of the first candlestick. This pattern indicates a change in market sentiment, as the bears are gaining strength and pushing the price down. Traders use the two crows pattern as a signal to sell or go short on the security. The bullish abandoned baby pattern occurs at the bottom of a downtrend. The first candle is a long and bearish candle that represents the momentum of the downtrend. The second candle is a small and bearish candle or a doji that indicates indecision in the market. The second candle doesn't overlap with the first or third candle. The third candle is a long and bullish candle that confirms the trend reversal. On the other hand, the bearish abandoned baby pattern occurs at the top of an uptrend. The first candle is a long and bullish candle that represents the momentum of the uptrend. The second candle is a small and bullish candle or a doji that indicates indecision in the market. The second candle doesn't overlap with the first or third candle. The third candle is a long and bearish candle that confirms the trend reversal. The advance block is a bearish reversal pattern that signals a potential end to an uptrend. It consists of 3 consecutive bullish candlesticks, with each candlestick opening within the previous candlestick's body. However, the body of the second and third candlestick should be smaller than the previous candlestick, with increasingly longer upper shadows. The advance block pattern indicates that buyers are losing momentum, and the stock's upward trend is running out of steam. The long upper shadows show that sellers are stepping in to push the stock price down. The pattern is confirmed when the fourth candlestick opens lower than the third candlestick and continues to decline. As with any trading pattern, it's essential to wait for confirmation before making any trading decisions.